I now recognize Mr. DeBoer for your witness testimony.
Well, thank you very much. I think I'll just align myself with your remarks. That seemed to be right on point. But seriously, thank you for holding this important hearing today. It is frequently, I think, misunderstood because real estate is so intertwined with the economy, how important it is to the economy, and you both highlighted many ways. Let me just point a couple of other things out. The industry directly supports more than 15 million jobs in the economy. Real estate asset values and transaction volume provide the principal source of tax revenue for local budgets, paying for education, road construction, law enforcement, emergency planning. And people oftentimes don't think about pension fund, but pension funds invest a substantial amount of money in commercial real estate, and those returns build nest eggs for the retirement for millions of people. I also want to be clear that today the commercial real estate industry is not here seeking a bailout of any sort. We agree with what you're saying. Let's understand the problem and get in front of it, but there's no bailout. To the contrary, and again, consistent with what you said, we believe all stakeholders, regulatory and private sector, should work together to make sure that real estate continues to be a prime part of our economy and enable cities to grow, business needs to be met, and housing challenges to be beaten. I want to focus my comments, my oral statement anyway, on two sectors of the real estate commercial market that are on the top of your minds, the office sector and housing. Regarding the office market, stress began to elevate in 2023 as the uncertainties of the post-pandemic office space use came to be better known and then became combined with higher inflation-induced operating costs and higher inflation-fighting finance costs. These factors, in essence, created a perfect storm of significant challenges for the office market. But even in office markets, there are notable differences. Some individual owners are facing considerable pressure, potentially leading to foreclosures, as you mentioned, defaults, and large losses of equity. At the same time, many top-tier modern office buildings with strong ownership and workplace amenities are currently weathering the storm. Most commercial real estate bank loans, by the way, are 8 to 10-year terms. They're frequently interest only, and many times they were originated with floating interest rates. You might want to look at what came before to understand where we are today. The environment of government-mandated artificially low interest rates began in earnest in 2008. Rates increased marginally over the next decade, but they remained historically low during that time period. Commercial real estate markets, office markets in particular, were in balance, roughly about 12% office vacancy at that time. It's easy to forget that the Fed was holding the federal funds rate at around zero as recently as the first quarter of 2022. Moreover, commercial real estate loans from that period are generally considered to have been originated quite conservatively, 50 to 60% loan to value and a strong debt coverage. The Fed started hiking rates, as we all know, in the first half of 2022, and in a span of roughly 18 months, raised rates 11 times, bringing the key Fed funds rate to a target range of 5.25 or 5.5, the highest since early 2001. Not since the 1980s has the Fed hiked rates at this speed. Around this time, as concerns about a recession increased, regulators for banks began calling for increased loan loss reserves on commercial real estate lending, and they also called for a reduction in commercial real estate loan portfolio concentration. In other words, not only were financing costs rising rapidly, but financing availability was shrinking. Liquidity was contracting substantially in all commercial real estate markets, but particularly office. For example, in the second quarter of 2023, the overall commercial property debt market rose only 1%. Diminished market liquidity and the drop in transaction value in turn increased pressure further on property valuations. It is in this environment that nearly half of the $4.7 trillion property debt market originated during the government-mandated low interest rate period is scheduled to mature by 2027. This is an environment where base interest rates have risen nearly 500 basis points in a 24-month time, and one in which lenders are urged to reduce their commercial portfolios. There have been, and it's worth acknowledging, helpful policy actions. Principally last year, the federal regulators issued guidance where they instructed lenders to work with creditworthy borrowers, and they gave flexibility to restructure maturing commercial loans. That was helpful, but more needs to be done. Banks need to be encouraged to restructure existing loans with new equity. These new loans should be classified as performing, and they should also reflect transitory assets. When a new owner comes in, they have to move that asset into a stabilized position. That shouldn't be criticized. I also want to mention office use space. During the pandemic, authorities sent people home, and that was probably the right thing to do. And the real estate industry worked diligently to provide safe work environments and to accelerate the reopening of activity. Today, returning to in-person work is critical to the health of cities, local economies, tax bases, and small businesses, as you've mentioned. But while the private sector office space occupancy is slowly picking up, the federal government workforce is behaving as if the pandemic still exists. This is despite President Biden's call for agencies to return to work. We applaud the work of this committee in the Show Up Act, and we think that more effort should be done. It's passed the House. Let's get it through the Senate. In summary, this self-reinforcing cycle of higher financing costs, less credit availability, and fewer transactions must be broken. And it certainly should not be made worse by adopting pro-cyclical measures such as the Basel III endgame and other regulatory matters that will restrict credit and capital formation. And the federal government should get back to work. Now, regarding housing, yesterday a coalition sent a letter to Congress cataloging a host of pending items that we have, including converting obsolete buildings into housing, increasing the low-income housing tax credit, volume caps, incentivizing local zoning and permitting reforms, increasing efficiency in the Section 8 housing voucher program, and more. Finally, I would like to note that rent control and eviction moratoriums are on first blush appealing concepts, but they've proven time and again that they're counterproductive to addressing the housing shortfall. I probably went over time. Thank you for your indulgence, and I think I only said in conclusion once, so thank you.
Thank you, sir.